Hello, traders. Welcome to this new live stream. Hello, Soda. Hello, everyone. Welcome back. Today is not just another trading session. This is one of those days that can generally shape the direction of the financial markets, not only for the next few hours, but potentially for the next several weeks, even months. We are talking about the FOMC press conference and the decision on the Fed fund rates led by Jerome Powell. As you can see, I already set the live streaming on Bloomberg and the Bitcoin chart. So it's an event that consistently brings volatility, guys, shifts sentiment, and very often set the tone for the global markets. So let's be honest right from the start. The Federal Reserve is in a very complicated position today. We are at a true macroeconomic crossroads. On one side, inflation is still a concern. Recent geopolitical tensions, as everyone knows, in Middle East, combined with pressure in the energy markets, have the potential to trigger a new wave of inflation. Oil prices, in particular, are something that Fed cannot ignore. Let me show you and share, for example, here we have the future on crude oil, and we are close to $100 again. So this price cannot be ignored by the Fed because they directly impact consumer prices and inflation expectations. On the other side, however, we are beginning to see clear signs that economy is slowing down in US. The labor market, which has been one of the strongest pillars of the US economy, is starting to show the first cracks. Hiring is slowing and job opening are declining, and there is a growing risk that the unemployment could begin to rise in the coming months. So the Fed finds itself trapped between two risks: tighten too much or keep rates too high for too long, and risk punish the economy into a deeper slowdown or even a recession. Or easy too early and risk losing control over inflation, which could come back stronger than expected in the future. So this is why today's decision is so delicate. And now, if we look at the market expectation, the picture seems almost too clear. At the moment, around 99%, 98.9% of market participants are pricing in no change in interest rates. And this is where things get interesting, because when positioning becomes so one side, when everyone is aligned in the same direction, the market becomes extremely fragile. It takes very little, a slight change in tone, a slight unexpected comment to trigger strong volatility. So even if the decision itself is widely expected, the real focus today will not just be on what the Fed does, but how it communicates. As always, Powell surprised us with some comments. In the past few weeks, we have also seen a very stronger US dollar index. Let me take it here on the TradingView. We have seen a very strong US dollar, appreciating against most asset classes, and this strength reflects a market that is still pricing relatively tight monetary conditions compared to other economies. But here comes the key point. Despite a strong dollar, despite macro uncertainty, despite all the pressure, Bitcoin and the crypto market are holding surprisingly well. Prices are not collapsing, and momentum is slowly turning positive. Let me remove some drawings. And most importantly, there is a growing perception that capital is quietly positioning. Also, our TA trends is showing that on the 12 hours and 1 day, we have some buy signals. And if investors start to anticipate a future shift in monetary policy, whether that means rate cuts or simply a less aggressive stance from the Fed, crypto asset could be among the first to react. This is why today is so important, especially for us as traders, because we are not just watching a rate decision. We are trying to interpret the next phase of the macro cycle. All right, 7 minutes left to the rate cut decision, come down to the Fed rate decision. Another crucial element to keep in mind is that context around Jerome Powell is, for example, that we are approaching what could be one of his final phases as the head of the Federal Reserve. And historically, in these moments, central bankers tend to avoid drastic moves or aggressive forward guidance. So, what can we expect, guys? Most likely, a cautious approach by Powell, a balanced tone as he always used, and attempt to keep optionality open. But again, markets don't move only on decisions, they move on interpretation, and they move on news about the dot plot. So they move also on small details like the choice of words, the tone, the confidence, the lack of it, and especially if something is not being said. So sometimes what is optimistic is the more important than what is expectedly stated. So let's wait for the decision and then the Powell speech.
As for the Fed meeting, I think I'm expecting this to be more of a placeholder meeting. I'd probably expect more of a bearish bias, which is a hawkish bias, I should say, for the Fed. And the changes to the summary of economic projections are going to be quite interesting. I'm expecting them to push up their expectations for headline and core inflation, and perhaps bring down their expectations for growth for this year.
So, Badr, have we seen the peak of the yield curve so far? We've seen now the 2-10 spread now at the tightest going back to November of last year as people price in the Fed remaining on hold for longer and lower long-term growth projections. Is that trend going to continue?
I think that the 2 stance curve does look very flat. I don't really see the prospects for the Fed switching from an easing bias to a tightening or a hiking bias, just like what we're seeing perhaps with the ECB and other global central banks. I think that the Fed stays on hold for longer at best, and that should keep the two-year yield somewhat within the current range or slightly higher perhaps. Unless we shift towards a hike, I don't see two-year yields really starting to rise. But that said, I think that, like I was saying earlier, I think that the growth prospects and the potential for a meaningful slowdown in growth next year would mean that the yield curve is going to have to remain somewhat flat. So the investors are going to continue to buy the belly.
So, Badger, communication is key. And in this news conference, the chairman is bound to be asked about his future. If he commits to staying on, because Kevin Walsh won't have time to be confirmed. In your mind, I'm interested in your individual perspective on this, your judgment as a market participant. Does staying on provide consistency or invite controversy?
I think it definitely provides consistency. What the market's looking for is a steady hand from the Fed and the committee at large. I mean, what we don't want to see is kind of a temporary Fed coming in and not knowing what the direction of policy is going to be. So to me, I think the best way to transition would be from Powell to the next Fed chair in an orderly fashion, as opposed to having somebody interim and then having to switch back to Powell. So that's kind of what I'm hoping for.
Subhadra, good to see you. Thank you. Subhadra Japa there of SocGen. Bob, just to turn to you, same question. Do you agree with that?
I think him staying on creates stability. Personally, I believe he'll stay on past the midterm elections.
Past the midterms?
Past the midterm
Why will
election.
he stay on?
Because he'll want to ensure that the market sees the independence of the Fed, that he's already been there for 14 years. He's a stabilizing force, and they can't be politically influenced.
Will he stay on as Fed chair or as governor or both?
I think after the midterms, he will no longer be Fed chair, but I think at the May meeting and perhaps the July meeting, he will be still the Fed chair. It all comes down to what Tom Tillis decides, what the courts decide on Lisa Cook and the suit against Jay Powell. All of that resides with Tom Tillis.
The show used to be simple.
Right? It's got complicated, hasn't it?
It's just unreal.
The Fed's got complicated. Neil Datter of Renmag writing again, Walsh, no matter what, will walk into the Eccles building as the weakest Fed chair in recent memory. He's limping in. The opinion of Neil Datter just moments ago.
In part because of skepticism by the market, but also in part because this is just a difficult economic time. There isn't a consensus to be had on exactly how you grapple with stagflation.
This is not a small matter on real and also nominal GDP and all the distractions we've got now. And I want to talk to Claire about that when he shows up. But to me, the weaker economy is a really interesting trend.
We're 60 seconds away from a decision. And a lot of people in this market will be looking for dissent, and dissent from some governors in particular who are worried about the labour market. And on the same committee, the very same committee at the very same meeting, there's a collection of officials on this committee who are worried about overshooting the inflation target for the past 5 years. That's how divided that committee is right now.
How do you deal with a paradigm shift with an oil shock thrown in, where you have AI creating real questions about productivity at the same time that you do have inflation, but you also have the potential for more efficiency?
Crude has gone from in the 60s when the Fed last met, the morning of the last Fed meeting at the end of January, to in the 90s, off the back of a shock in the Middle East and a major rally over the past 2 weeks plus. The scores heading into this decision look like this. Equity markets this afternoon on the S&P declining by 0.6% in the bond market. We're looking at 2s, 10s and 30s shaping up as follows. Yields on a 2-year at 3.71. With that Fed decision, here's Mike McKee.
No change in rates, no change in dots, one dissent, but some big changes in inflation expectations. Fed officials see one cut still in 2006 at some point, even though their statement notes that uncertainty about the economic outlook remains elevated. 3 members who favored no cuts in this year moved their dots down to 1. The statement goes on to say, the implication of developments in the Middle East for the U.S. economy are uncertain, and the committee remains attentive to risks to both sides of their mandate. They still see one more cut in 2027. Stephen Myron, the only dissenter, he wanted a quarter-point cut this time, and from the dots, we discern that he still wants 100 basis points at some point this year. The language about future moves remains the same. They still talk about the extent and timing of additional adjustments to the target range. It's the summary of economic projections in which we see a lot of changes. PCE inflation this year is forecast at 2.7%, up from 2.4% in December. Core is also seen at 2.7%, up from 2.5%. Both dropped to 2.2% next year, up from 2.4% in the December SEP. Core is seen at 2.7% this year. Both drop back, as I mentioned, next year to 2% in 2028. GDP marked up a tenth in both years, both of the next 2 years, to 2.4% this year and 2.3% next year. The unemployment forecast remains 4.4% in 2026, dropping to 4.3% next year. That's up from 4.2% in December. And the longer run estimate for Fed funds, seen as the proxy for the neutral rate, rises a tick to 3.1%. Guys?
Mike McKee, thank you, sir. We'll catch up with you a little bit later. Let's start with the price action. We'll go equities, then bonds. We'll have a sneak peek of what's happening in the commodity market because we're tracking that throughout the day here at Bloomberg. Equity markets, looking at the S&P 500, off session lows, but still negative by 0.5%. In the bond market, yields slightly higher on a 2-year by 2 basis points, basically as you were at 370 on 2s, on 10s at about 421, which is basically where we were going into this decision. So this is what we're doing. You go into the projections. We'll ignore the statement just for a while. We'll go into the statement and we'll look at the projections and compare what they were projecting back in December and have a look at what they're projecting now. So let's just go through 2026 for GDP, revised slightly higher. That's some good news. 27 as well. Same thing, by the way. So they revised GDP higher, they've revised inflation higher, and they've kept the projection, the implied projection for interest rates exactly where it was for December. Those kind of moves should be music to the ears of bullish market participants.
This is an incredibly dovish hold, just by virtue of the fact that only one person dissented, and it was Governor Myron. That alone. But these projections highlighting a tolerance for higher inflation and still the belief that it will come down by 2027 to that 2% level without hiking rates and continuing with rate cuts gives you a sense of where this Fed's mind is at. This seems like more of a consensus than I expected, than a lot of people expected, and it is more to looking through any kind of oil price shock.
In honor of Alan Greenspan's 100th birthday, it was a Greenspan decision. Everybody got on board with the chairman. That's all there is to it.
And the out years, the good news on the inflation front, you decide whether this is good. The Fed is still basically forecasting the same inflation glide path as they were before, even with this lift to 2026.
How do you say transitory without saying transitory?
Right? It's in there in the forecast.
And that's the reason why you're seeing the yield curve steepen. And on the margins, you're seeing 10-year yields higher on this because ultimately this is a Fed that is willing to stay on hold and look through an oil price shock, look through the fact that even core PCE has been higher than expected and is expected to stay that way. Because ultimately, they do think the labor market is showing signs of cracks, even though they don't necessarily see unemployment rate ticking up. And they do want to err on the side of being more accommodative.
One official I'd like to speak to, just briefly, get him on the phone. Governor Waller.
I was about to say, Chris.
No dissent. He said it was a coin flip. It would come down to the labour market report, and that labour market report was overwhelmingly soft. So what does he see in the outlook for inflation that's kept him on the sidelines?
Governor Waller, please join us. If you want to call in, we'll take you. I mean, ultimately, that is one of the key players because he is a pillar of the swing vote, if you will. And a lot of people are looking to him for some sort of guidance about what exactly is driving his decision.
But at Washington State, he was expert on game theory. And when there's a war, there's a different game theory.
This is a major shock we're working through. Bob Michael at JP Morgan Asset Management still with us around the table. Bob, do you have any thoughts off the back of this one?
I do. They're telling us, don't worry about it. There's a little bit of a near-term inflation shock. They added a tenth more than we did, but it's fine. The economy is going to use that to accelerate. So they increased GDP. That I don't get. And they left unemployment where it is. And it also doesn't sync with the dots. I heard Mike McKee say that 3 members who previously voted for no cut changed their view. And went to a cut.
The median dot 3.4, December projection, the median dot 3.4. Joining us now to discuss is the former Fed Vice Chair, Richard Clarida. Now, Rich, I know the word transitory is banned and they can't use it anymore, particularly in the news conference, but does this scream transitory?
Well, it certainly screams we need a synonym for it. Temporary, not long-lived. You know, they could justify it perhaps by looking at the oil futures, which still show this as dissipating over time. But the short answer is nobody, including the Fed, knows. This is very elevated geopolitical risk, and there are risks on both sides. But the baseline, I agree with your panel, is dovish constructive.
Rich, I'm just wondering how much this is just AI written all over it. How much this is a Fed that is basing their entire assumption on a productivity boom tied to artificial intelligence and the deployment of it through the economy, and frankly, disinflation on its heels.
I think there's an element of that, perhaps more so with the incoming chair than some other members. I think it's also a statement, however, that AI is a support to demand in the economy that to some extent, along with those big, beautiful bill tax cuts, is probably going to offset some of what the drag would be from the oil price increases. But again, this is a modal or a baseline, and I think certainly internally we'll hear that there was a discussion of the risk cases as well.
Professor Clare, when you were at Columbia herding cats, Xavier Sala Martin taught the acclaimed principles of economics. Talk to us about the risk of a demand destruction here. To me, it's extraordinary, whether it's war, short-term, or a more permanent demand destruction. Should that be a legitimate concern of the Fed?
Well, the demand destruction comes simply from the fact that not only oil prices, but energy prices and goods that are intensive in oil and energy will go up, and that will tend to reduce the real incomes for millions and tens of millions of households. Now, on the other side of that, you have the AI boom, but there is no doubt that this is going to squeeze real aggregate demand the longer the oil shock persists.
Check out the price action. Let's go to equities. We're still down by 0.6%, unmoved by what on the surface of things looks like a dovish decision from the central bank. Check out the bond market, similar story, no big moves off the back of this. The only takeaway, this can change, but the only takeaway for me is there is nothing this institution can do to drive this market in the face of the shock elsewhere. Jeff Curry of Carlisle said it really well earlier this morning on Bloomberg TV, when Jeff turned around and said there's nothing the central bank can do about this, you cannot print barrels. This market is still at the mercy of what happens in the commodity market, and the Fed is not the circuit breaker anymore, because this Fed decision, I would sit here and argue, is fairly dovish, with the exception of the absence of a dissent coming from Governor Waller, is fairly dovish. To come out and say the outlook for growth is better, we've revised higher the outlook for inflation, and the median dot is exactly the same, screams dovish, and yet here we are. No big moves in financial markets. I think that's notable.
The Fed is playing dodgeball without the ball. They're not the pitcher in a game. And right now, what they're dealing with is shock after shock without necessarily historic precedent. Yes, there are historic precedents for oil shocks, but not for the AI shock and what that does to the overall economy. So they might remain on hold, and that might be bullish, but not in this moment, because right now, if another oil or natural gas plant gets bombed, people are going to be watching that much more than anything coming out of Jay Powell.
You know, Vice Chairman Clare, the thing I would point out here, Damien Sassower at Bloomberg is very cautious on EM suddenly here. In this meeting and in this press conference, more than ever, is this the central banker to the world?
Well, sure it is, and I think that the Fed is aware of that. I think one thing this episode is reminding folks. We've seen it in the dollar, obviously. Is, you know, since the Iran hostilities commenced, you know, the price of gold is down, the price of the dollar is up. So I think there is that element as well. But, you know, broadly, the Fed is reacting to events. I think Lisa said it well. First and foremost, this is a major geopolitical and economic shock. The dodgeball analogy, I think, is a good one. So I think, yes, the Fed is the central banker to the world, but it's not the main attraction right now.
Bob Michael with us with JP Morgan as well. What is the, with the tentacles of JP Morgan around the world, how is EM doing? I see Philippine peso almost out to 60. You saw Australia raising rates in
whoa. We're calling Australia EM?
No, I'm not calling Australia EM.
Get you in trouble, TK.
No, I'm watching Oz again, though, which is a life of its own.
Sydney, watch it.
Was it Swissy?
Their early morning. Deeply unhappy with that.
But I read all the Neville Shute, including Tom like Alice. I want to know, as a central banker of the world, the sensitivities he faces. What does JP Morgan see on the reaction in the currency markets, the reaction in fixed income of EM as the chairman speaks?
I think there are a couple of things. One, we felt going through this that the dollar would be the safe haven bid. And we're seeing a lot of that. We also felt for those who wanted to diversify away from dollar, emerging market FX was the place to go. The central banks in those regions seem to be on top of things.
Yeah.
And you had a split between those who are energy importers and those who are energy exporters, those that are sitting on rare earth minerals and other minerals, and those who aren't. And I think we're seeing all of that play out. But I will tell you, our client base still feels underallocated to emerging markets, both equity and fixed income. We're seeing those allocations continue to come in. I think there's a good tailwind there.
We just went along Australia.
There you go. Back-to-back hikes of the emerging market central bank over the RBA. See that?
Yeah, well,
Honestly, there's some offended people down under right now.
I'm not wearing it on this one, but I will say that tomorrow will be really interesting at the BOE and the ECB.
There you go. You tell them, Bremo.
All right.
Rich Cloud is still with us. Rich, I want to come to you on an important topic to wrap things up, a really serious one. The future for Chairman Powell. This is not how usually these things play out. Typically, how this plays out, the chairman knows when his term finishes, he gets a great send-off, he walks away, and he does a $1 million speech in about 12 months' time and has a happy retirement. This feels so different, Rich. Kevin Walsh is ultimately being nominated. We have no idea when the confirmation hearing is going to be. Bob Michaels sat here a little bit earlier and said he thinks the chairman, Jay Powell, is still going to be there by the time you get to the midterms. Rich, how do you think this process is going to play out in the next several months?
Well, you're absolutely correct. This is unprecedented, unusual. That the handoff is usually pretty smooth and very well telegraphed. And the difference, of course, now is several fold. One, of course, is the DOJ investigation of Powell that the Fed is pushing back on. In addition, of course, even Walsh getting a hearing is now up in the air. I certainly do expect Jay Powell will stay on. And perhaps a meeting or two after Walsh finally arrives. Whether or not that's after the midterms, I'm not sure. I think Jay Powell will move on once Walsh is in place to his future life. But his real focus is on maintaining the independence of the institution. And I think he will be in place until Walsh is confirmed and perhaps a meeting or two thereafter.
Rich, appreciate your insight on the topic. Thank you, sir. Rich Clarida there, the former Fed Vice Chair on this Fed decision and the Chairman's future. If you are just joining us on the program, welcome to the show. So unchanged, the policy rate of the Federal Reserve about 15 minutes ago. Some dissent, the vote 11-1. That dissent came from an obvious place. Governor Myron voting for an interest rate reduction for the projections. Big focus on what was happening with inflation. They've lifted their outlook for inflation for this year, at least, but left the median dot, ultimately implying one rate cut from this Federal Reserve for 2026.
To me, the most interesting takeaway is what you said, which is this market doesn't seem to care, even though this is very much a dovish hold. This actually is news in Fedland, and yet the market doesn't pay attention because there's another game in town, and it's everything else in the world. And some people might say, oh no, the adults can't control this. They can't step in and save us. And the other people will say, we haven't had a free market in a long time, and this is what it looks like. And guess what? It's a welcome exercise. And so those two sides of the debate are playing out in markets today.
Got a free market?
Well, I mean, that's the whole thing. Ultimately,
it's too exciting.
Well, I'm kind of excited about this. I mean, that's kind of a nice thing, not to have the thumb on the scale all the time and same story over and over again.
It's a change.
All right.
It's a change.
Okay.
Stephanie Roth of Wolf Research. I can see how excited you are. You're not alone. I've been waiting for that moment for a long, long time. Major moves. 5% away from all-time highs.
Even the Japanese market. It's now exciting. Who knew?
They're actually trading the benchmark in Japan now.
There's actually traders.
Stephanie, I'm sorry. Stephanie Roth of Wolf Research joins us now for more. Stephanie, we need your reaction to the decision and what you expect the emphasis to be in this news conference.
Yeah, I mean, the emphasis is going to be on the reaction function, provided that energy prices end up staying longer. The question is, are they going to end up looking through this, or do they ultimately end up having to be dovish as a result because growth will end up slowing? And our own view is that because the economy is so different today versus 2022, they'll ultimately have to be more dovish as a result of the war in Iran rather than the opposite. Otherwise, it tells you a story of productivity and that growth is actually going to be higher in the future years, but then nothing else changes. And the one thing that we didn't talk about, or that wasn't talked about yet, was the longer run dot shifting up a little bit.
Well, this to me, Stephanie, that I'm really wondering about is how much does a more dovish Fed enable something that looks more like 1970s or more like 2022 and what we saw with inflation and the read-through? Is that something of a concern for you?
No, because the backdrop is so different today versus, say, 2022. If you look at 2022, the unemployment rate was 3.7 heading to 3.5. Today it's 4.4. Payroll gains are growing at 600,000. Today they're somewhere between 0 and 50,000 on average. The inflation backdrop was different. Core inflation was 5.5. Today it's 3. So the idea that we're going to have a repeat of 2022 seems like a very low likelihood event, and therefore that's not something I would expect the Fed to react in that way because the data probably won't support a reflationary type of environment.
Stephanie, given a war, given what oil's doing, John mentions it's 60 to 100 or even higher, we're still slaves to the job market. And the answer is the unemployment rate hasn't broken. With the war, with the distractions, how ex post is this Fed into the summer?
Yeah, I think they're going to be in an environment over the summer where base case the unemployment rate is probably steady, but they're going to be looking at this most closely. That's going to be the deciding factor between whether they're able to cut, probably not at Warsh's first meeting, maybe in September or December.
Right.
And it's going to all go down to the unemployment rate. Is it notably above 4 or 5, in which case they have a window to be able to ease? And if not, then it's going to be tough for Warsh to get the rest of the members on board.
Bob, synthesize Michael Feroli's work on this then. The fact is the labor market hasn't cracked yet. They have to wait, don't they?
I think that's part of it. I'm still gobsmacked by the Fed's decision. They're basically saying all of this going on in the Middle East is a speed bump. That, inflation will tick up, 0.3 and 0.2 here and there, but the economy will accelerate, unemployment will stay stable, and it's off to the races. I just don't see that. I think there is a real impact to inflation and ultimately to the economy and the labor market.
This is the heart of the matter, John. This is the absolute heart of the matter, and everybody has to recalibrate their x-axis to how long is this going to go on, and then you get to demand destruction.
We mentioned this earlier, and I think it's important to keep going over it. We've repriced a lot in this market. We've repriced energy. Had a big move from the 60s out to triple digits. We've repriced interest rates. We've taken out a lot of easing for the Federal Reserve, and we've priced in hikes in places like the ECB, 2 of them, I think, for this year now. Yet we haven't repriced growth, and the Fed hasn't either. And I'm not just talking about where spot is trading or the front month on the futures curve. If you go out to December and look at where December is trading right now, we're close to 80. So we've gone from the 60s to close to 80s on the December contract, and the Federal Reserve has lifted the outlook for growth. What's driving that?
I wonder how much momentum they think is in the economy, how much AI and data center spending is going on. Were they surprised by the Delta earnings and that, sales are at a high despite higher energy prices? I think the reality is when you've had close to a 50% hike in energy prices, it's a tax on businesses and households, and they will respond by cutting back some of their consumption.
We have the smartest viewers, and I just want to point that out.
Sure.
One of the viewers just wrote in, we do, and pointed out that among the members, the actual dots might say one thing, but the risk to GDP downside included 14 members versus 8 prior at the December meeting. The risk to the upside was 16 members for core PCE, as well as the unemployment rate. That was up from 12 and 13 members respectively. So that stagflationary outcome still in the back minds of so many of these Fed members.
All right, guys, I'm back. So the Fed holds the rates unchanged and maintains the projections for one more rate cut this year and another cut next year. Personally, I don't think that this will be the reality because AI impact will be devastating on the labor market. So that is very unlikely scenario. Let's have a look quickly on the Bitcoin chart. 10 minutes left to Jerome Powell's speech. So let's see what Bitcoin is doing on the 5 minutes chart. Since noon of today, Bitcoin dropped around like 4.4%. We have reached perfectly the SSL, the sell side on the 1 hour, and now the price is trying to bounce back. We also touch the POC in a perfect way. So let's see if we can find some buyers and some strength to recover all these 3 fair value gaps based on the 1 hour time frame.
Show up the labor market. I don't think we're going to get a lot of jobs from those. That brings up the issue is the problem in the labor market more structural and systemic, something that rate cuts alone cannot cure and spur the demand for workers on? If that's the case, if you cut rates further, you're risking a more persistent bout of inflation, or worse, a stagflationary scenario. And I think the devil in the detail is in that stagflation scenario. Also important is that they raise their non-inflationary rate. That is reflecting, yes, productivity growth and the idea that the economy can grow more robustly without having inflation, but that also means higher non-inflationary rate, which is an important marker to put down before Kevin Warsh takes on as Fed chair, since he has argued that productivity growth should lower that non-inflationary rate. That is not what the Fed is saying. And I think that's very important. But I am very concerned about, we're 5 years in, we've got consumers expecting more inflation than they did in late 2024. And those expectations are going to rise, especially with salient prices like prices at the pump going up. And there's already a long tail due to the problems in the Middle East. Production idled is not easily brought back online. It's weeks to months, and we're rolling supply chains the world over. You create scarcities that go below the destruction in demand. That gives you stagflation.
Dan, is this the Fed meeting where forward guidance just died?
Absolutely. We didn't have a lot of forward guidance to begin with, but absolutely. And I think, what really will be interesting in the chairman's comments is what was the debate in terms of growth, what went into these numbers, how did the debate fall out. I think the devil in the details here is that there is a bit of a stagflationary concern out there, and there should be.
Diane, there's we suffer from 3 zip code scenario here in New York City. You've got a much greater national perspective. I take real issue with the narrow part of America being affected by $5 a gallon gas. How much of America is going to be flat on their back from some of these shocks?
Well, unfortunately or fortunately, we do have fiscal stimulus right now, and that fiscal stimulus will help absorb the shock instead of going into other kinds of spending, and that will help households. Tax refunds are showing up in consumer bank accounts right now, but the combination of fiscal stimulus with, remember, inflation is accelerating right now. We saw PCE accelerate. We saw the PPI numbers today. The translation of the PPI and the CPI for PCE for the month of February, hotter, especially on core services. That's aside from what's going on in terms of tariff-based inflation. That is important right now. And I think that's getting lost in translation, but it does show up in the devil in the details of those dots and how the forecasts show up. You could have had one very strong forecast push up the GDP number within the group. There are people who believe within the administration that we'll get 5 to 6% growth this year. That was their forecast going in. If Steve Moran wrote down a number like that, that would have raised the overall growth figure, when in fact the rest of the committee is seeing a more stagflationary scenario. I do think it's a dovish pause. That is a bit disappointing right now, given where we're at, even though I'm very worried about the labor market. I just don't think the Fed can cure what ails it.
So, Diane, what do you think the emphasis, where do you think the emphasis will be in this news conference with Chairman Powell in about 5 minutes' time?
I think the emphasis is going to be on uncertainty and wait and see. And that will just sort of be where they are right now, and that they don't know where the next rate move is actually going to be. And I think that's the right way to play it.
Dan Swank. Dan, always good to catch up with you. Thanks for being with us. Dan Swank, they're breaking down the Fed decision. If you are just joining us, welcome to the program. The news conference about 4 minutes away with the chairman of the Federal Reserve down in Washington, D.C. In any other time, at any other moment, we'd be talking about a penultimate meeting of the Federal Reserve Chair, but we have not spoken to a single person today who thinks this is the penultimate meeting of the Federal Reserve Chair. And most believe Chairman Powell, including the former Fed Vice Chair, is going to be sticking around for at least a few more months.
Partly because we don't know when the confirmation of the next Fed Chair is going to be, and that ultimately lies with the man from North Carolina, Tom Tillis. Ultimately, though, there is this question about credibility for the Fed, continuity. I just wonder if he gets up there and he says, what we do doesn't matter right now. As long as we don't hike and as long as we don't cut that much, we're not in the driver's seat. I mean, ultimately, this is their pass to say, this is an economy that's moved on from us. We are not in control. We are watching it just like you.
Unspoken, John, will be the idea of the recent election results, including yesterday in Illinois. And I also point out a set of allies saying no to the president on this war, and that Mr. Powell, representing the institution, will stay around more so than the last meeting.
A big piece of this bull case for this economy and for this market has been tax refunds. We hear that phrase get bandied around all the time on this program, tax refunds, tax refunds. How big are these tax refunds actually going to be? And how are attitudes towards the economy changing given the shock of the past few weeks? Where will that money actually go?
Well, we're seeing it now when we look at Chase deposit accounts. We're seeing particularly the bottom couple quintiles of earners see their deposit balances start to go up a bit. But the uncomfortable truth is they're now paying that out again at the pump. And we can't forget that businesses and households were already paying a higher tax because of tariffs on prices. And now energy prices are going to create yet another tax on their disposable income.
Grandma, the squeeze is real. The energy bills are severe, and they were high already, and now they're getting higher.
You know, Delta and American were perfect examples of how the economy is doing pretty well and people are still spending. The difference is that the costs are getting that much higher. And so the room that people have and that companies have to do okay is getting narrower and narrower, and the Fed's watching this, and they don't have the silver bullet to really make this a better situation.
I did scientific surveillance research today.
Here we go.
EWR, the Charles de Gaulle, was popping the two of us. You could easily do it for $7,000, and you're enjoying it this morning just under $11,000.
Are you pretending you don't fly business
Over
class?
three. That's well,
Is that what you're doing?
No, it's not premier. We're not going the first class thing, but
Okay.
business class, I'm going to suggest is up at least 20% instantly.
Is that Polaris? Is that United Business Class? Is that the front of the plane?
I actually
United?
don't even know. Yes, actually I do. I remember going to something, a demonstration about it, not actually, not exactly experiencing it. I remember seeing
For everybody to know,
It's a different world.
for everybody to know out in the world, John and I are in steerage, and you're on the Gulf
Oh,
Stream.
that
450.
is such a load of.
Nice one, TK. Hey, Bob, before you go, just a final word. About a minute away from this news conference. What are you looking for?
I'm looking for a couple things. I want to understand how they're thinking about the war and the elevated risk to both sides of their mandate. And then secondly, I want to know how they got to their forecast numbers. I think Diane's right. There needs to be some explanation there. And the explanation could be quite simple. It could be, well, one member put in a 6% growth rate. Okay, well, let us know that.
Well, let's get into it in just a moment. The chairman of the Federal Reserve entering the room.
All right, guys, it's time. Just listen, Jerome Powell.
Good afternoon. Both my colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation, as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind. And the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? I'm just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year, progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Howard.
Thank you, Howard Schneider with Reuters. It's just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your
the consumer's going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption, that'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. It's something quite different than that. We might have much lower than expected pass through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one, because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down, and we don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement, and you also, what you've written down before you'll be reluctant to move too far away from that, just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market the unemployment rate, of course, is little changed since September. You have a very, very low break-even rate, apparently, for new jobs, with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So your question was
what the staff is saying about, and has said in the past.
Yeah. So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable, and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rate rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But the net of the oil shock will still be some downward pressure on spending and employment, and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, and but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be actually, and it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick.
Nick Tamaros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay, so I would say that the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals.
All right, guys, another irrelevant speech from Powell. The Fed continues to monitor the situation based on incoming data, taking things meeting by meeting. We still don't know how the crisis in the Middle East will impact prices. Unemployment is slowly rising and the labor market is cooling down. The questions keep coming, but Powell at this point sounds like a robot, repeating the same things over and over again. Bitcoin attempt a short-term reversal, but the 72K level is now acting as resistance. Now let's see if the POC can hold as support. Meanwhile, the traditional markets are falling. So let's see how this conference will end, but probably the scenario for Bitcoin will be like a sideways phase and probably a break to the downside if buyers don't step in, but volumes actually are increasing. So for this special live is it's it, and yeah, thanks everyone, traders. See you the next webinar. Good trade to everyone. Bye.